Hello friends, today's topic of discussion is capital market and money market. This is the second part of capital market and money market. In the first part we have discussed up to components of capital market, and now in this video we will discuss about money market and its components. So what is money market? Money market instruments are short-term financing instruments aiming to increase the financial liquidity of businesses. It is a financial market where short-term financial assets having liquidity of 1 year or less are traded. In the money market, securities can be converted into cash easily and therefore preserves the cash requirements of an investor. The money market and its instruments are usually traded over the counter and therefore cannot be done by standalone individual investors themselves, but through certified brokers or through a money market mutual fund. Money market facilitates the participants' short-term borrowing need through trading bills. The participants in these financial markets are usually banks, large institutional investors, and individual investors. Since the securities being traded are highly liquid in nature, the money market is considered as a safe place for the investment because this gives minimal time for any default to occur, and RBI controls the interest rate of various instruments in the money market. And if we talk about objectives of money market, then money markets help in lowering short-term deficits. It also helps the central bank in regulating the liquidity in the economy, as is the short-term fund user to fulfill their needs at a very reasonable rate, and contributes to the economic stability and development of a country by providing short-term liquidity to government, commercial banks, and large organizations, helps in designing effective monetary policies. It also facilitates in streamlined functioning of of commercial banks. Now let's move to components of money market. Money market components are treasury bills, certificate of deposits, commercial papers, repurchase agreements, call money, notice money, and term money. And the last is bankers' acceptance. Let us learn about these one by one. So, the first component of money market is treasury bills. Treasury bills are issued by central government and are one of the safe money market instruments. In treasury bills, the returns are not that attractive. They are zero risk instruments. They come in the maturity of 3 months, 6 months, and 1 year. The central government issue treasury bills at a price less than their face value, and the difference between the buy price and the maturity value is the interest earned on the instrument. The buy value of treasury bill is determined by the bidding process through auctions. At present, the government of India issues three types of treasury bills through auctions, namely 91 days, 182 days, and 364 days. Certificate of deposits. Basically, it is a certificate issued by a bank to a person depositing money for a specified length of time at a specified rate of interest. The certificate of deposit is an agreement between the depositor and the bank where a predetermined amount of money is fixed for a specified time period. Issued by Federal Deposit Insurance Corporation and regulated by Reserve Bank of India, the certificate of deposit is a promissory note, the interest on which is paid by the bank. The certificate of deposit is issued in dematerialized form, that is issued electronically, and may automatically be renewed if the depositor fails to decide what to do with the maturity amount. It also restricts the holder from withdrawing the amount on demand or paying a penalty otherwise. These are the features of certificate of deposit. First is eligibility. Not all the institutions or banks are allowed to issue certificate of deposit. There are certain conditions laid down by the RBI that allow the purchase of certificate of deposits. Next is maturity period. A certificate of deposit issued by commercial banks can have a maturity period ranging from 7 days to 1 year, and for financial institutions it ranges from 1 year to 3 years. Minimum investment amount. A certificate can be issued to a single user for a minimum of 1 lakh. Fine. Next is transferability. Certificates that are available in demat form must be transferred according to the guidelines followed by demat securities, while dematerialized or electronic certificates can be transferred by endorsement or delivery. Next is discount offered. Certificate of deposit is issued at a discount rate on a face value. Moreover, banks and financial institutions can also issue certificate on a floating rate basis also. Fine. Next is non availability of loan. Since these instruments do not have any lock in period, so banks do not grant loans against them. In fact, banks cannot even buy back certificates of deposit before maturity. Next component of money market is commercial papers. Commercial papers are short term unsecured promissory notes issued by corporate and financial institutions at a discounted value. They come with fixed maturity period ranging from 1 day to 270 days. These are issued for the purpose of financing of accounts receivables, inventories and meeting short-term liabilities. The return on commercial papers is high as compared to treasury bills and are less secure in comparison to these bills. These securities are actively traded in secondary market, and it is easy to find buyers for the firm with high credit ratings. Commercial paper is not usually backed by any form of collateral, making it a form of unsecured debt. Next is repurchase agreements. Repurchase agreements are short term loans that buyers and seller agree upon for selling and repurchasing. For example, a bank sells bonds to another bank and agrees to buy the bonds back later at a higher price. These are also known as repo or reverse repo. The reverse repo transactions can be done only between the parties approved by RBI and allowed only between RBI approved securities such as state and central government securities, treasury bills, PSU bonds, that is public sector undertaking bonds, and corporate bonds. They are usually used for overnight borrowing. Repurchase agreements are sold by seller with the promise of purchasing them back at a given price and on a given date in the future. Also, the buyer will also purchase the securities and other instruments with the promise of selling them back at a selling them back to the seller. Next is call money, notice money, and term money. As we all know that money market primarily facilitates lending and borrowing of funds between banks and other entities. Banks and other entities borrow and lend overnight or for short period to meet their short-term mismatches in fund positions. So, with respect to call money, the funds are borrowed and lent for 1 day, whereas in notice market, they are borrowed and lent up to 14 days, and the term money is for more than 14 days without any collateral securities. And the commercial banks and cooperative banks borrow and lend funds in this market. However, the all India financial institutions and mutual funds only participate as a lenders of funds. Last component of money market is bankers acceptance. Bankers acceptance is like a short-term investment plan created by known financial firms backed by a guarantee from the bank. It's like a bill of exchange stating a buyer's promise to pay to the seller a certain specified amount at a certain date, and the bank guarantees that the buyer will pay the seller at a future date. Firm with strong credit rating can draw such bills. These securities come with the maturities between 30 to 180 days, and the most common term for these instruments is 90 days. Companies use these negotiable time drafts to finance imports, exports, and other trades. This was all about capital market and money market. I hope these videos help you understanding capital market and money market in brief. Thank you for watching.